Hello, lovely humans. Jen Foxbot here. Super excited because this Math Mondays is a very special edition. It's interactive. Woohoo! So, what that means is that in this first part, I'm going to give you a problem to solve. Yeah! In part 2, I will give you an overview of the mathematics if you need a little bit of help. And then in part 3, I'll give you the solution. So what that means is watch part 1 first, and then try your hand at doing some calculations. You are smart, just think through some things, and it's okay if you try some things and it doesn't work out, not a problem. If you need a little bit of help with the math, or if you want to check your ideas, watch part 2. And then once you are confident in your answer, you can watch part 3 for the solution and to compare what I get with what you get. Okay, so with that introduction, are you ready? It's story time. Yeah! Okay, so it's 2020 and you are lucky enough to meet Annie, the time traveler. Woohoo! Annie's super rad and you two hit it off, and she agrees to take you back to the year 1926 because you're super curious about the roaring 20s and you also want to know what it was like before the stock market crashed. What kind of a mood were people in? How were they feeling? How did they feel about the economy? There's some good parallels and things we can learn from history. So, you go back to 1926, you meet some cool people, you try on some rad clothes, and lo and behold, you manage to get your hands on a $1 bill. Woohoo! So fun! So, you want to plan ahead. Annie tells you you can't bring it back because it'll break space and time. But what you can do is put it somewhere for safekeeping, and then once you go back to your own time, you can take what you have earned from that $1. So you have a few different options for what you can do to make sure that that dollar stays in safekeeping and maybe earns you a little bit of money over time. That would be nice, right? Then you could really help your family out. Okay, so option 1 is you open a bank account, you deposit the money in the bank, and then you go whisk off to the future. And then in the future, you get to take out the interest that you have earned from that $1. Okay, so the bank is willing to give you an average annual rate of return of about 3%. And this happens to be about the same rate of increase as the average annual inflation rate in the United States. The other option, option number 2, you can buy a fairly low risk government bond. And in 2020, you're like, the United States government still exists, so I can get my interest from the bond back. That's a fairly safe bet. The government bond will give you an average annual rate of return of about 5%. The third option is to invest in the S&P 500. What is that? So basically, this is lower risk than buying an actual stock in a company. This is what is kind of called a managed fund. So there is a person who kind of looks at the stock market and they pick and choose a group of companies to spread your dollar across. So a few cents go to this company, a few cents go to that company, a few cents go to this company. And this person manages where your money is, and they try and pick things that are fairly stable and fairly large companies. So this is lower risk than an actual stock, but higher risk than a bond or a bank. The average annual rate of return, since you know from 1920, is about 10% on these. And the fourth option, which is the highest risk, is to pick a company that exists in 1926 that you know will still be around in 2020. So if you choose this option, you will expect an average annual rate of return of about 12% if you choose a company that still exists in 2020. So one example might be Columbia Pictures, which was founded in 1924, or maybe Ingersoll Rand, which was founded in 1871, or the Texas Pacific Land Trust. I had to look at my notes for that one. And that one was founded in 1888. So any of those three companies, you could use an average annual rate of return of 12%. I would accept that. Or if you want to do a little bit of extra credit, you can look up what the average annual rate of return for that specific company was. I would give you bonus points for that, and maybe like a virtual cookie. Okay, so really quickly, what is an average annual rate of return? Well, basically, it's the amount that your dollar will increase in a year. So for example, if you look at the bank option, if you start with $1, you would take $1 and add $1 times 0.03, which is just 3%. And that would give you the value of your dollar in year 2. Cool. So with that information in hand, sit down, crunch some numbers, and figure out which of these 4 options you would pick and why. When you have your answer, leave a comment and explain to us why you picked that option. Because to me, that's the most interesting part. If you decide to go with a lower risk option, explain that. If you decide to go with a higher risk option, also explain that. Cool. Let me know if you have any questions about this story setup or about the mathematics, but I would recommend if you get stuck, watch part 2 and then let me know if you have questions about the math. Cool. All right. Have fun. And I can't wait to see what you get. Yay!